Right. Welcome to this meeting of the Finance and Strategy Management Committee. Question number 1, apologies for us.
Indeed, yes.
So we've been nice to go.
We've got apologies from the Mayor, Councillor Sarah Miller and Councillor Walker.
Declaration of interest. Receive any interest relating to the business sector of this meeting? Do we have any? Item number 3, public participation. Questions, comments from the members of the public gathered here in front of us. Unless Charles or anyone else to join in, and we'll move on to item number 4, minutes. The approval of minutes of the meeting held on the 14th of September. Councillor, you're proposing? Yep. Harrison, you're seconding?
Yeah.
No comments or all in favour?
Okay, just now that we've approved those minutes, can I just ask for an update from the town clerk on item 34 regarding the progress on grants for the adventure golf? What progress has been made?
So we did look into the capital grant scheme with District Council. I spoke with the officer administering that scheme. Unfortunately, they wouldn't be determining grant applications until next February or March, and therefore the build wouldn't be able to start until after that time. Although you can apply for up to 75,000, that's a limit which is that amount isn't usually given out. It's usually around about 50,000 to 20,000, and so to delay the build by 4 or 5 months. Actually, we'll be making more than the last time, but we couldn't apply for that in the build. And the build has already started this week as well. Actually last. So it would feel like we would be able to continue the grants effectively.
No other grants? So, National Lottery grant. I'm just trying to not have this council put in 250,000, which is an awful lot of money, when if there are, no, they have to apply for grants and it's a process of going through it. But if there are grants that can be got, then 10,000, 15,000, 20,000, then it means it's less exposed to us. National Lottery, Golf England. I don't know what other grants are available.
No,
I raised it.
Well, hold on. This isn't really on the agenda. So, and you've asked the question, and the accountants have given you an answer. Both officers are happy to respond and respond very quickly to queries outside the meeting. So you do feel free to ask them outside the meeting, in meetings where, unless it's on the agenda. Okay, with the permission of the meeting, I know that item 9 is a report from the investment managers, and I'm sure that they're desperately keen to hear about the headway leads in our code of conduct. But I'm going to suggest that we bring that item forward. I suggest we do it after item 5. I might be possibly interested and usually doesn't take long anyway. So I'm going to suggest we move item 9 to after item 5. Everyone happy with that? Yeah. So item number 5, finance, to receive the national papers and the other account to the agenda. If there aren't any comments on those, I'll propose that we receive them. Block, receive the note. What's in favour? Okay, right. I'd now like to invite the 2 investment managers. We've got a table or place.
Would you like to sit next?
You bring a chair up and sit on the end.
You already signed his letters.
So the format will. I've known people think differently. Nick and Charles are going to present their reports and then we'll do a reasonably short question and answer of the issues that were raised as well as the character. But Nick, you're going to start off.
More than happy to do so. First thing, I suppose, really is a recap of your objectives, which is on page 3. Ultimately, from our point of view, the council asked to generate a return of inflation of 3.5%. With a long-term investment horizon, subject to occasional drawdowns from capital projects, balance of returns from capital and income, and target ESG score for equities of between 20 to 30, which is medium using sustainability. In terms of how this is delivered, a diversified portfolio, equities to bonds, property, and alternatives to moderate volatility. Global equities have average volatility of at 13.6%. Your portfolio with us has volatility of under 7%. So those non-equity elements contribute to bringing the volatility down from that experience to pure equity. Geographical diversity, steady monitoring of volatility and asset weightings to ensure that risk remains appropriate. The capacity for risk under which we operate is 1 out of 4 on our scale. There is no industry standard definition of risk. I hasten to add, every outline is its own. The weighted average sustainability score for the equity in the portfolio is 23.35, which is within your 2030 stated range. On the next page, in terms of where things stand at the moment, the current value as of Friday is just over 1.93 million. The estimated annual income is just under £65,000. The running yield on the portfolio is 3.33%. A year ago, the portfolio was worth about 50,000 more than it is now. However, in that time, you've drawn out £200,000 and had 67 and a bit thousand pounds of dividend income. The total return over 1, 3, 5 years and since inception are shown below that. And so the portfolio is doing what it's meant to do when measured against the ARC benchmark. ARC, I just remind you, is the asset risk consultants benchmark of outcomes across the industry. Charles, I know, will have something slightly different to say in regard to that, because again, he's benchmarked against the ARC balance, which is on a moderate basis, and the risk profile. Sorry, I'm just popping through relatively quickly because I don't want me just reading stuff in front of you. And I know that you've got lots to get through. The current asset allocation, about 15% of this is in UK equities. The outlook from our point of view is that while there's a lot to be said for UK equities being cheap at the moment, there's also a lot to be said for the UK economy having some broader question marks over it than others around the world. So the weighting in UK equities is not huge. The main thing I want to talk about is the rest of it, the ESG, because I know that's been an ongoing building focus. On page 6, this is why I think it's an area that's got to be looked at from lots of different angles. So the example I've given is cement manufacture, again, about 7% of global CO2. Second only to iron and steel. You could easily just read that and say, well, cement manufacturers don't fit in that the portfolio, though, huge carbon footprints and so on. As an example, CRH, one of the biggest players in the sector, has a huge range of ESG credentials. There's a list of them there, but the key ones are things like low rating from Sustainalytics, 19.7 score. In most of the ESG indices run by Stockton, NFTI, and so on. US Sustainable Development Goals, CDP climate change rated A-. So its ESG credentials and the list of them that they tout are huge. So maybe one ought to say, is that enough? Is a sustainability score or signing up to the UN Sustainable Development Goals not enough to make it worth considering? And you could say yes. In this case, despite all of these things, this is the business that over the last 3 years started with a huge carbon footprint, has reduced the CO2 per ton of product in its app by 4%. And had a higher sulfur dioxide and nitrous oxide and nitrogen dioxide output now than it did 3 years ago. So, for example, we generally wouldn't consider it as a constituent for an ESG focused portfolio until we start to see some of these things come through in what we're actually doing, not just in what they say we will do. So a lot of their ESG credentials are based upon by 2030, we aim to have cut our CO2 by this much. Until they start doing it, we probably will continue to avoid, despite everything that this is an ESG clean business. So the different ways of doing this, exclusion-based criteria, you've already done some. The council stated they are moving towards zero holdings in tobacco, chemicals, mining, oil and gas, and gambling falls under that exclusion-based category. As of now, 1.43% of the assets fall into those categories, down from about 11% when we first talked about this face-to-face 2 years. One holding in Rio Tinto, which just needs the right moment to be done. You could take a best in sector. CRH is fine if it's the clean, if it's the main company working hard, and we could take that. By that token, one has to throw back into the melting pot some of the things you've already taken out of it and say, well, is the cleanest oil company or gas company better than the dirty ones, and therefore it should not include it. I think the difficulty with this is that at the moment, companies are rushing to prove their ESG credentials. You can't pull up an annual report and that's in the logos for all of the various initiatives which they profess to be members of. I think one of the things you have to bear in mind is that there's a lot of S&G in these things. You can sign, let's say you're signing up to the UN Sustainable Development Goals, because you've identified some of that wide range of things that you don't contribute to or you're actively working against. So no one in our supply chain employs kids in sweatshops in Southeast Asia. Great, fine, there's, that one of the UN Sustainable Development Goals is to improve working. So I think really from our point of view, while it's a subjective filter, good company managers do accept that proper moves in these directions improve profitability. The days when this was seen as being something called cost of money as a business have gone. So I think that the best in the sector approach is getting easier because companies are getting better in their disclosures, but it's still, as I said, it's money. Positive selection. I quite like positive selection bias because at least it allows one to make a company by company judgment. So, for example, you're not just talking about excluding certain things and trying to find the best businesses in other areas. You're talking about companies that either overtly, that's what they do, it has an ESG focus and that's their main business, or companies that have a broad range of boxes. So, for example, over a third of the current portfolio fits from our point of view under that sort of approach, either because their main business is decarbonisation, renewable energy, social housing. And those sorts of things are much easier to look at. Yeah, and you can say, fine, is that social housing? It's a bit like the idea of putting concrete down for a golf thing and so on. You say, is that social housing as green as it could be and so on? But broadly speaking, the main thrust of their business is one firmly under an ESG head. And then thereafter, we would expect to see not just single things like sustainability scores, UN Sustainable Development Goals and so on, but a broad combination of them that actually stand up to some scrutiny. Of the remainder of the portfolio, about 44% fall under a sort of neutral category. So the government guilt doesn't really have an ESG tag to it. You could argue, oh well, the government borrowed that money to build social housing or to do something else. It wasn't borrowed specifically for that money. It falls into that. It's not a bad thing. It's not a dirty oil company or anything, but it's not necessarily something you could ever put under any of the other positive categories. No holdings from our point of view are currently rated as severe by Sustainalytics, which is one of your criteria that you should have no holdings in that category. One is rated high, which is 1.43% of your money, which is Rio Tinto. give you an idea, the global distribution of equities at the moment is that 41% of all ratings by Sustainalytics are either high or severe. So in terms of the council's position compared to world markets broadly, you are regions ahead of the median if you threw a dart at the FT and pick a random selection of global equities. In terms of how you go forward with it, on page 11, I think is the crux of things, because while on the one hand, what you ask to 30, nothing in the severe category, no oil and gas companies, gambling companies, and so on. You're pretty much all there. But we still think a blended approach is the best way if you want to be clean rather than look. Looking clean is easy. Find any number of these initiatives and say we'll only invest in things that subscribe to them. But it doesn't necessarily mean that you are. So, for example, again, MSCI rate Rio Tinto is A-rated on their ESG scale, and you can see underneath that's because of their corporate governance and their water stress and their health and safety and so on. But Sustainalytics rated as high because on many other measures, digging huge red holes in the ground and pulling out raw materials isn't a tidy business. So we still feel very much that it's not about any one measure. None of them do all of the job. We could use one of them. If a client wants to, that's absolutely fine. But we would always caution that you may feel clean, won't necessarily be clean. Just at the tail end to that, in terms of where things are going, markets-wise, growth and inflation remain the main talking points. The main issue at the moment is how sticky inflation will be. From 6 months ago, everything was saying inflation is just prices rebounding after COVID as economic activity resumes. It looks a lot more sticky than that, but the general consensus is still that a lot of it will tail off. The issue is if wage claims catch up and output prices continue to match this, then central banks will end up responding. At the moment, our own view is that it's still unlikely that we'll see any rise in base rates beyond 0.75%. That's a long way from 0.1%. Still pretty moderate. At the moment, the global growth forecasts from the IMF are still pretty reasonable, tailing off a little bit in 2022 to about 4.4%. The Federal Reserve has started to tail off its economic stimulus package. But at the same time, while that was a sort of concern for a while, the markets were a little bit nervy about that. The combination of strong jobs growth and Biden's huge infrastructure spending bill have calmed things. Continuing crackdowns on private business in China, for example, all private tuition companies were recently told effectively you're not private businesses anymore. And concerned about some high corporate profile debt events. So very much from our point of view, cautious optimism rather than any great sense of exuberance about the markets. I think that the situation looks considerably clearer than it did even 9 months ago. But there will still always be things on the horizon that wobble it. And companies are reporting pretty reasonable demand figures and so on, but they're always experiencing the same supply chain issues. And they're all in a situation where their balance sheets are a little bit frailer than they were before COVID. So if all goes well, they're in a great position to capitalize on growing GDP and demand, but their resilience, should there be any interruption to that, is considerably lower than it was. You got it from there.
Thank you, Nick. Okay. Yeah. Charles, you like to have a go?
Probably not a lot I can say. The beauty of going second.
Let's say you went first, I didn't do that.
Okay,
Room up for next time.
let's have a quick canter through the report. Page 2, long-term returns, going back to 2009. Your portfolio is growing at 9% per annum. Your target is 2.5-ish, so RPI plus 3.5. Compared to the MSCI WMA income benchmark or index, that's growing at 7%. So you're comfortably ahead of recognized benchmarks, and in particular against the peer group, which is the ARC Balance Index, that's grown at 5.67% over this period. So you're ahead on pretty much every measure over the longer term.
I'm assuming that isn't ARC optimistic as well. I guess there's a cautious balance there.
The steady growth is the next risk profile up, and then there's an equity risk, which is the highest degree of risk that you can get. So there are four categories. Page 3, the 5-year summary. Your portfolio over this period has returned 40.8%, and again, comfortably ahead of the respective benchmarks. We consider this that we're managing the portfolio on a medium risk basis with an income objective, i.e. we're aiming to produce £75,000 worth of income, and that's what we are projecting going forwards. The yield, therefore, is 3.2%. The bottom left-hand quadrant on page 3 shows the asset mix, and you're broadly equally exposed. UK equities 29%, international equities 32%, and about 20% in fixed interest. Over the page 4, there's more granularity and detail on this asset allocation mix and the 1-year performance data. And what is very obvious here is the strong performance from equities by comparison with fixed interest securities, which have performed poorly, which is what you would probably expect with the anticipation of inflation accelerating, and therefore then interest rates possibly going up at the tail end of this year, but actually more likely in the spring next year in the UK, probably towards end of 22 in the US. There's been a very strong period for equity markets over the last year, and the portfolio is up 17.6 in the year to 30th of September. Then we turn over the page to page 5, and again, I've just set out the asset allocation, which we've already looked at. The ranges that we're permitted to go between the minimums and the maximums in different asset classes, just so you can see where we're positioned. I'm slightly nearer the higher end of the equity weighting, which you would anticipate in this current economic environment. But the other aspect is the risk measurement, and Nick talked, I think, about 7% for your part of the portfolio. My bit of it's running at 7.69 volatility, so we are slightly riskier, which again is reflected in the mandate. The drawdown is about 14.5%, as you can see. So that's from peak to drop when the markets fall. So we're just slightly riskier than the MSCI WNA income benchmark. But by comparison, the conservative benchmark, considerably lower volatility, much more defensive, but I don't think that is what I've been given as my objectives. All the criteria specified in the investment strategy document, point 4, A to F, all of those have been complied with and fulfilled too. Just reiterating point 3, income objective 75,000 forecast for next year. Then we come on to the ESG things, and just put in very simple terms. Our understanding, having signed up to the Stewardship Code and the UN Principles for Responsible Investing, as you move from the left-hand side of the chart to responsible, sustainable, impact only, which is exactly what Nick was talking about, how much you build into a portfolio, how much you screen out, etc., etc. And we're essentially in the sustainable bit, but moving increasingly to the impact part of the investing phase. And I put the new investment ideas that we've incorporated, so things like Sequoia Infrastructure, the Global Clean Energy Fund, the Renewables Infrastructure Fund, SDCL, Energy Efficiency Fund, etc., etc. So we are clearly moving from the left-hand part of the chart to greater sustainability, greater impact in this. I then use the Sustainalytics data, which of course can only really measure the direct equities. You can't look at the collective funds. That's very much a subjective part of the analysis. But to summarize, your portfolio has a score of 19.1 on Sustainalytics measures. So you're comfortably on the low side of your target, which you set us, and the categorization is low risk category. So that's page 7. You will see there is one high risk stock, which is energy. It's a business that's transforming itself from old-fashioned power to being the biggest offshore wind farm operator in the North Sea. So some of this data is backward looking, and again, as Nick said, these are businesses in transition, and from what we see, what they say they're doing, we think their score will be considerably better over the next few years. But technically, it's still ranked as high, the only one in the list. Overall, your portfolio is low. I then looked at things in terms of carbon disclosure projects, which, as you will appreciate, is a charity. It sets greenhouse gas emissions. I put the table in to show how all the stocks that we can measure are ranked. And on the right-hand side, the weighted score coming out at 6.3, the higher the score, the better, comfortably ahead of the UK stock market. But there are some peculiarities. There's Phoenix, which isn't willing to participate in this and not willing to give the information. The government may force these companies in time to disclose, but at the moment it's not mandatory, and that distorts the data. But you can see how they rank, and as much as anything, it's a commitment to improve on their carbon and greenhouse gas emission. CRH, you'll see at the top of the list. Nick has given a very clear guidance there.
Sorry, I didn't know you had any. An example, we went Harvard and think it would be a neutral term.
No, I absolutely understand your standpoint, and it is interesting how in many pure sustainable funds it features. You're absolutely right. It doesn't score particularly well on the carbon issue, the greenhouse gas emissions. It did score reasonably well on the ESG Sustainalytics criteria, but as you say, it's mostly down to the governance issues, not so good on the environmental. It's a filthy, dirty business producing cement. But it's improving. I think you don't think it's improving, whereas I think it is improving. Well, I think the reason you think it's not bigger is because actually it's a much bigger business. It's been growing steadily. So it depends how you gauge these things. Anyway, it's in my bit of the portfolio. Just quickly turning over then to the Sustainable Development Goals of 17. Again, I put a table in to show how your portfolio looks. Again, better than the UK stock market by quite an appreciable amount. But there are some negative scores in here. So things like Diageo, Associated British Foods, Compass Group. That's very interesting that one of the main objectives is no poverty in the world and zero hunger. Now, it's somewhat odd then to consider that food and drinks companies could score badly, but of course they're not doing enough because they're selling the stuff to us, privileged people. They're not selling enough to people who are suffering from poverty, are suffering from hunger. So they score badly on that criteria. But it's interesting how one looks at these things. But overall, I think your portfolio looks relatively good on those sustainable development goal objectives. Page 10, I give you an example of something that we've put into the portfolio in the last year. It's probably not worth going into the details. You can read it all later, but essentially it's a business that might come into the town hall and say, all these light bulbs need replacing because they're kicking out too much energy, using up too much energy, and we'll replace them all for you at a cost. That's how we make our business, but it will save you a lot of energy. So they will go round to big industrial sites, to big warehouses, to big supermarkets, etc. So it's all about cutting down energy usage, transmission of energy, where there's a lot of loss, etc., etc. But it's a very interesting business and meets your criteria to generate income as well. Then go on just for a quick summary of where we are in the world. I mean, I think it's really said it all. COVID does still remain an issue for many economies. We saw a lot of problems in Asia in the last few months with restrictions there that caused particular problems in China, where they're very draconian with their measures to curtail the spread of it, but equally in Malaysia and Singapore and Thailand. So a lot of the production has lost in the Asian markets, and that's clearly had an impact over here in the West. The result of which is stagflation. So that means a combination, essentially stagflation, combination of stagnation and inflation. If that really sets in, that's a problem. We don't think it's going to be a problem yet, because we do think that the inflationary part of it is transitory, because those supply bottlenecks will begin to improve, and we're beginning to see factories opening up again, particularly in Asia, and the supply constraints that we had in the summer beginning to improve. But inventory needs to get in the right place, and it takes time for that to happen. So we are getting a slowdown in economic growth. You can see that in the charts. So we don't think the stagflation fear is going to be an ingrained problem, but it's a temporary issue that we've got to get through at the moment. Turning over the page, page 13, clearly global cost pressures, as we will all be aware of, when we fill the car up with fuel or have to pay for our heating bills, etc., or just food shopping, prices are clearly going up. And the question is how long that's going to continue for, and we have a similar view to next that we'll probably see the prices peaking, inflation peaking in the UK at around 5% within the next 3 to 4 months, and thereafter beginning to turn down. What is very evident is that consumers are spending money on things because they haven't really been able to go out and go to the pub, go to the theatre, go to the cinema, etc., go on cruises, etc., go on holiday. So they've been buying things, and you look at retail sales and the number of sofas that have been bought, gone through the roof over the last year or so. So there's a huge amount of pent-up demand that is going on goods, not on services, and that's being reflected in these inflationary figures. Finally, just very quickly, page 14, we look at the sort of overview of markets produced by Citigroup, just to see where we are in relation to previous beginnings of bear markets, i.e. when markets sell off. So in March 2000, the peak in the market then, October 2007, before the great financial crisis, and the red flags clearly are a warning sign, and there are quite a lot beginning to develop in economies, particularly in the US, mostly because it's relatively overvalued. There's a lot of debt in the system, and rather like Nick, I'm getting somewhat more cautious, not perhaps not cautiously optimistic, but increasingly cautious and taking a more defensive view with the assets in your portfolio. Page 15 is a summary, essentially, of the things that we've discussed. And as I say, just beginning to get a little bit nervous that we've travelled very well this year. You know, your portfolio is up 18%, and it's probably prudent just to be a little bit more cautious, build up the cash levels, and wait.
Okay, thank you, John. We generally go around the table and allow people to ask a question of which you. Next time we do that, we'll start with Ken and then go around this way. I'm going to be last. So you want me first, Ken? I'm fine. You're fine, Ken?
So this one is up 18%. What's your one up by?
11.93% to in the year to 5th of November to Friday.
Thank you. Right, yeah, questions.
Well, thank you. I think an education is true. Right, thank you. Excellent. Thank you. Charles, you mentioned you're getting a little more cautious because I'm just looking at the bear market.
Yeah.
Indication. Where are you switching to? Because it seems as though there's a bit of gloom in all markets.
Yes. One would normally switch to fixed interest securities, but then they're not offering any great value at the moment. I think what I'm going to be doing is raising the cash levels a bit further, and I'm going to put a little bit more into alternative assets, infrastructure assets, where there are some good yields. And we can see with the bill that's just gone through in the US, infrastructure bill has just been approved, there's clearly a lot of demand for those assets. And there are a couple of very interesting new issues coming to the market. One from Pantheon, which I'm going to be subscribing, or have subscribed to. I think it's technically closed today. I can't remember. Anyway, it's so that's basically how I'm positioning.
My final comment is thanks to both of you for looking after our payment month. Well done. It's really good.
No, that's it from me, thank you.
Yeah, just a big thank you. We have travelled very well this year. I was interested in the ESG debate as well. I'm also interested in the fact that we sold half shares in Royal Dutch Shell. Is that a company that's in transition? So you thought, well, just sell half because you're coming to the meeting here and they gave us an indication that we should move stuff out of Shell, because that company could transform, and do very green things. I don't know whether BP or Shell are any better than each other. And is there a reason why you only sold half?
I've sold them all now.
All right.
By that point, I may well have sold half. 2 years ago, when this first came up, one of the things that came out when this was first discussed in the meeting 2 years ago, and the council precluded any new investment in stated industries on an exclusion basis. One said that they wish to exit any existing holdings in those industries. So from my point of view, they had to go, it was just a case of when.
Right.
In that intervening 2 years, of course, the price of oil disappeared to almost nothing. So while reducing it in line with the council's stated desire, there's no desire to rush out and sell them at £8 a share. So the most recent one, for example, we sold at £18 a share, because of the point where that becomes a credible exit point to then move the money elsewhere. So it wasn't a case of whether I believe that Shell is a dirty polluter. You guys included ongoing investors in it on the basis that you wish to not, over time, to move to a situation where you have zero in oil and gas, gambling, chemicals, mining, and
I concur that
so
what we should absolutely, we went down the right route of giving you an indication to go towards what you did with ESG, but if there is something that has to stay in the portfolio, that is with Rio Tinto and Shell or cement, for example, just for the sake of the next meeting, then perhaps we.
which is why I didn't rush to sell on the day you said it. It's a case of you left the window open in terms of saying this is the direction of travel we would like to see over time. So hence the fact that it's become a case of removing the holdings at what one feels are credible points to do so, rather than just saying, great, fine, well, let's just take a red pen on day one, regardless of the value or whatever. I mean, I think that that's the tricky bit. Not going back into them is easy, because it's just a case of those aren't eligible investments for the council's money as direct equity holdings in future.
But if Shell became a very, very green company and you then thought it was worth going back into it, you wouldn't have a problem in recommending.
I wouldn't have a problem in contacting the council and saying, I would suggest that you look again at your stated investment policy document, because I think it's a credible route. I think the difficulty with that is that, let's say chemicals companies are excluded. If I found a chemical company that made an additive that would suddenly mean things like road haulage, which is not going to go electric anytime soon because lorries don't work well on that basis with current technology. And a chemical company that made an additive that suddenly took all the emissions out of diesel, I can't buy it at the moment. But if I came to you and said, I'd like you to remove chemical companies, then you get into the realm of saying, does that mean I've effectively then got an door to put the equivalent of IPI back in? So it is very difficult. I think sometimes you've almost got to be black and white, except that you'll potentially lose certain opportunities, but at least you'll do it with a clean conscience.
My second question is, as we build back better, are there any sectors in particular, like Amazon or DVD or delivery companies, we should be aiming ourselves towards, because of, given that COVID's happening, you know, the world has changed, we should be picking up on those industries that are booming.
You already have quite a lot of exposure, I think, you probably, I would suggest, in Parliament as well, because things like you've got, so we hold things like, the current portfolio, there are things like robotics and automation ETF, a carbon decarbonisation enabling ETF. There are things like a lot of the infrastructure sort of things that Charles was talking about. So we also hold Sequoia in the portfolio. You know, I think that one of the things that there are an increasing range of choices from our point of view as to how we do this. And so if you go back even 3 to 5 years, trying to find things with strong ESG credentials that will be the 0 yield or a ridiculous premium to the real value of the assets was very difficult. As it's become more of a focus area for money, the range of choices has improved. So there are now things like businesses that sit complementary to a lot of these growth areas. So, for example, the growth in wind power has given rise to complementary industries like energy storage businesses. So industrial batteries may not sound particularly green, but they're necessary so that when the wind blows in the middle of the night, there's somewhere to store that electricity to then feed it into the grid during the day and when peak wind demand is. So there are a number of choices out there.
My only point is, I don't think we should be changing the framework. I think it's working quite clearly, but I just think we should be trying to draw down less. Whenever I see the word draw down, I think in the journey we've been on, to try and do everything we can to not draw down, given where we currently are, where going forward with the investment managers.
Oh, just thank you very much for the two very clear presentations. And I think you both already mentioned, if you think that everything we're doing is being overly restrictive, then rather than just thinking, we're being bootstrapped by, I don't know if you do our finances, but we do have a slight deficit at the moment, so anything that we can do to help address that with any increase in performance that we can get. Only helps us to provide greater services. That's the goal at the end of the day. If there is anything glaring we should do, especially given the grey areas around ESG, then you're welcome to it. Yeah, absolutely.
Liz, you want to ask a question?
I would like actually, so. not
We
really
do,
a
yeah.
answer, if I may. I just, in our investment policy, we have various stipulations, and I think I've sent you a copy of it. For instance, no more than 70% of the portfolio in equities to manage risk, but also to manage risk or to manage exchange rate risk. We say non-sterling denominated assets shouldn't exceed 45% of the portfolio value. And I just wonder whether we, how risky is the currency point, and whether that needs to be in there, because, Americans have done incredibly well over the last year or so. And I just wonder whether that's an unnecessary restriction for you, or whether it's valid.
Again, it depends how you do this, because, so for example, we could both go and buy a BlackRock branded S&P 500 iShare, for example. That's all going to appear on a pie chart as US equities. This is London, quoted in sterling, and so there isn't an exchange rate risk at the point of transaction, because one is pricing it in sterling at purchase and at sale. The fact that the underlying assets are in the States, and therefore that will translate into the unit price that we can buy and sell at if the exchange rate moves. I think that the way that I would have read that was in terms of natural currency of the actual assets where they're traded being in on a non-sterling basis. I think some sort of a limit probably does make some sense, because you don't really want to have necessarily a huge pile of direct investments in far-flung places with extremely volatile currency relationships with sterling. So I think something in there just to stop a situation where someone goes mad and buys you something that's the equivalent of Zimbabwean dollars in its natural currency, and regardless of the performance of the investment, the underlying investment, the performance for you as a council is massively magnified by those exchanges.
So we could have more than 45% of overseas investments, but not in the foreign currency within our portfolio. That's your understanding. That's what that
you effectively do in most
yeah.
ways. I mean, like I say, 15% of this is direct UK equities from our. No, it's a bit higher than
Yeah,
23 or something.
Yeah,
The majority of this money ultimately is spread around the world. It's spread around the world via vehicles that are priced and traded in sterling.
So it's not a major restriction for you then?
I don't think it is. I mean, we had this conversation a year ago, and I think we raised it.
Yeah.
I think it's sensible in the sense that you need to spend pound sterling, and so it does have a bearing on the positioning of the assets, what they then generate. So I think it is sensible to keep that restriction in place. I don't think it limits too much. I think we've got enough. scope and flexibility to position the portfolio sensibly. But I think it does stop you going to extreme levels in the international markets, which by definition will not generate you sterling that you need to spend. So I think it's a sensible restriction. I personally, and Nick saying the same, can work within.
And as you referred to last year, you came to us with a recommendation about the way in which the rules that set on the investment, how they were restricting our options in a way that was advantageous to us. We changed our instructions. And I suppose what Liz is saying, if you have any further recommendations of that sort, we're always happy to listen to your arguments.
Well, I think, I mean, I remember a few years ago, maybe when they came on board, I think we had a restriction of 30%, didn't we? And, you know, that did then force you to go to the UK stock market route, and clearly the differential performance that we've seen from the US has highlighted why that was the wrong strategy. So we've addressed that by moving it to 55%. Weighting, and I think that's about right.
At the moment, there's no figure that you would say is reconsideration. But if there is, then we'll make representation. Trevor, have you got any questions?
Yes, I think I might still question that you're probably going to ask. So apologies in advance.
I did deliberately put myself up.
You did actually. It's something that Michelle probably alluded to in her question. So obviously we have Charles, your instructions have been interpreted as a more balanced approach, whereas Nick instructions have been interpreted as a more cautious approach. I suppose the question is, was that the original intention of the council, that it almost wanted to have a second layer of protection by having one cautious and one balanced, or is this simply how it has been interpreted over time? And in which case would it be more sensible for the council to actually, does the council need one cautious, one balanced, or actually should the council just nail its flags to one or the other, and have them the same?
Pick up on this because I think I know the answer to both sides. The first one, in terms of should the council, is definitely for you guys. In terms of like the outcomes, I've got prints out of the outcomes over 1, 3, and 5 years for the council with the portfolio with us, and the medium outcome for moderate risk portfolios with us over the same time frames. And they come out looking not quite as good as, but within a percentage point or so of Charles. I know the reason, or I'm fairly sure I know the reason, which is the point at which you last had a review. Part of the discussion was about the priorities, and if overall you can achieve your objectives, then people tend to make a list of a wish list. If you say to people, what do you want your money and your investments to do? And they'll say, well, I'd like to get this much income, I'd like to beat inflation, I'd like to do this, that, and the other. But of course, what they forget to put right at the top is they'd like to lose a little bit if it goes wrong. And so I think the rationale was very much on the basis that we used to run a 1 to 5 scale, but 1 was deemed what we call low risk, effectively restricted to government gilts and cash, which is a 0 return gain. So hence the fact we just moved it to cautious, moderate, and effective, and progressive, the 1 to 4 range. And I think that was the rationale of it being cautious at that stage, was that the view from you guys was that if on balance you were taking as little overall as possible on constraining both, a blended view to get what you wanted, which was your objectives, then that was the way to go. We did send out, when we dropped the 1, we did send everyone a new risk profile questionnaire, which the council returned, which came back as cautious as the balance. of the various answers. In terms of if the council wanted to change it, if they did, it's easy to do. I give you another questionnaire and they answer slightly more adventurous at the end, and we would make the change. I think that the thing that you would probably have to factor in is that while statistically it would be more likely to give you two portfolios with much more similar outcomes, as Charles alluded to, it would give you two portfolios with, between them, on average, higher volatility. Volatility is a lovely thing. It works brilliantly. That's what makes you your money when things go well. And it's what costs you money when they go bad. So, you know, you have to be careful. Sometimes you have to be careful what you wish for.
That's all. Can I ask a very, very quick follow-up? Well, it's not even follow-up, but that was great. You both have about 2% in cash. Is that just to provide some low level stability? And if so, does the 2% really do that? So what's the reason for having it in cash?
It's incidental to me.
Yeah, I keep a bit in cash as a working unit, as and when opportunities arise. So, for example, the Pantheon infrastructure fund that I want to commit money to, I need to have the cash available to put into that new issue. So you always need a more working balance. The question is, do you, if, as I was saying earlier, as I'm getting more cautious, do I take the cash balances up to 5 or 6 or 7%, which you're not getting any return on, but you might be protecting at the margin the overall value of the portfolio, and that's
You're going to build a golf course. Don't worry about it.
and then there's, I was going to say, this might call on us to send some more money back as we have done over the last year or so.
Thank you very much.
I'd like to ask about the ESG index. Well, when we first looked a couple of years ago, we originally considered asking for target score between 20 and 25, and our current, well, in the end went between 20 and 30. And I noticed you are currently at 19.1 and 23.5. And so if we were to change that to 20 to 25, that wouldn't change anything, but it would send a clear signal that that the move toward the more ethical investment strategy by the town council had achieved already some of its goals, and we can reflect that retrospectively in the guidance. Do you have any problems with us changing that guidance? Okay, that's good. And maybe it'll even reduce further in the future. But we're always aware that this might be a approach. And as you've said, there's a high degree of subjectivity in the whole area of ethical investments. Yeah, true. Okay, right. Okay, that's any question I have to ask apart from charity. You want charity and pitch from me? Okay, right. Thank you. We can keep the table while we consider our one questions while I was going to under my agenda. You can say the table while we discuss it. So we have to consider our investment policy, which does relate to the questions I think specifically asked. So I think there were 2 points that I could think of came up. Firstly, that we change the on page 105 of the agenda in the on section 4H, we can change our target ESG score to 2025.
Well, as one was already at 19.1, would it be sensible to move it to 15%?
That would make sense. Yeah.
So what would be?
So the currently 4H in our investment strategy. says an ESG score of 20 to 30. I propose to change it to 20 to 25. And Sheridan suggested that we actually change it to 15 to 25, seeing as I think it's 19.1 is already slightly below that.
Personally, I would just have an upper limit. It doesn't matter what the lower limit is. The lower limit is always better. The lower limit is always better. So I would personally just have an upper limit.
That makes sense.
So
So a target ESG score of no more than 25.
Just to be clear, however, so that that doesn't conflict with the existing no severe trying to exit the highs, as it were, which is already in there. That effectively then is talking about 30 is the sustainability point where something becomes high, 20 to 30 is medium, below 20 is low. But we're talking about an average rating, a weighted average of no more than 25. We're not talking about excluding individual.
That's right.
yes, the average.
25.1.
Yeah, absolutely. It's the average of the portfolio, as you reported as being 19.1.
That's simply not.
Okay, so what I propose that we change 4H to be a target ESG score of less than 25. And we can vote on these in a moment. And I also think that the questions that Sheridan asked about the difference in the two portfolios, the way you've interpreted our instructions is kind of different, and that seems to me to be anomalous, and I'd like to line the two up. And I'd line the two up along, which keep you Charles as medium, but you Nick would then move to being moderate. But you need to send us a questionnaire. We need to respond, presumably.
And which again, I will never object to because it makes my life a lot easier. It broadens the universe of things one can do.
Right.
We need to go through the survey again, can't we just assume that we made moderate?
I'll then share a question now. I'll drop one off. In fact, I've got one behind me. So I thought this might. So I'll leave him with one as a gift. And if he bluffs, I'll talk it through it.
I'll hold it. Go through all the various permutations, and talk about different things. Starting again.
So let's take these two separately. First,
Could I just ask, could I just ask one question before we go on that? However, could I ask your advice? I mean, isn't there some advantage in having slightly different strategies? Because it means that we're covering our backside within the investment that we're doing.
It's entirely up to you guys. As long as, I mean, my only issue is that, as long as one accepts to a degree, one's comparing green apples and red apples.
Yeah.
But within that, there's nothing wrong with having two approaches. I think realistically, the one thing I would say is that we don't set that. That's based upon the original mandate and then the updates from the sporadically updating the risk questionnaires and the results that come from the information the council gives us. We will happily change it if the council wishes to. But at the end of the day, that needs to be something that's driven by you guys. In terms of, is there a case for being done slightly differently? Yes, there is. And from a returns point of view, there's a case for having them both done on a moderate basis. If times go well, you will get, it's reasonable to expect a better return from both being on a moderate basis. It's just a case of which matters more.
I think you're absolutely right, but I think there are two other aspects. If the benchmark is RPI plus 3.5, with your asset allocation in your risk profile, do you think you can, in the long term?
I might not have CPI plus 3.
Actually, because RPI plus 3.5 is actually a pretty demanding benchmark, and I don't know with your whether over the long term you will get to that level or not.
And my understanding, however, is that the council overall is RPI plus 3.5. And if they get that from some of the money over delivering and some of the money under delivering, but at lower
balance, yeah.
that doesn't matter. Again, it's a case of interpretation. whether one's seeing these things in isolation or as in the whole. And again, that's where,
Yeah.
to a certain extent, we need to be led by you guys.
And then the other aspect, of course, is whether assets that fall in a lower risk category actually reduce the level of income that is required overall. So we're set a target of 140,
Yeah.
40.
Were you sort of suggesting the two combined would be 140 before any more drawdowns that might happen? But that's actually down quite a bit on a few years ago. Although I know we have taken some drawdowns, but we used to have
165, I think.
yeah, and actually I was going to ask whether that is because of the COVID and dividend rates going down because of COVID, or because the way the portfolio works, you're in more assets that have more capital growth and less income. They have,
I
you know,
think it's a combination of things,
Yeah.
of the overall level of interest rates and therefore yield from assets generally has come down
Yeah.
in the last couple of years. So whether it's from fixed interest or from other yielding assets, property or alternative assets, the overall yield has fallen. And then the equities in the COVID period, dividends were cut in the UK by up to 45%.
So
At
they
worst,
might-
they've
might
been
go
rebuilt
down.
since then. So it has had an impact on the cash flow.
That
Yeah.
140 probably a year ago, if you bear in mind that when we send you guys evaluation, either of us, it'll be based upon, even if we think a company is going to reintroduce a dividend, it was a temporary thing. If its last declared dividend was 0, it'll appear as 0 on the valuation. That 140 will have been a lot lower a year ago. But the other thing I think is worth bearing in mind is that you've always got to remember that yield is just a mathematical expression of the market's view of risk. How much is someone having to pay you to hold these shares compared to someone else's shares? And a higher yield usually is a pretty clear mathematical indication that shareholders demand a higher level of income to hold your stock than someone else, because they attribute in some form or another a greater degree of risk to it or a lower element of growth. And so there is always a balancing act in there, and that's why, for example, we both give you figures on a total return basis, because at the end of the day, you could have a portfolio that delivers everything you want in Spain in income terms, but it will massively hamstring its counterpart.
Yeah, it helps our budget quite a bit.
Yeah,
That's what I was thinking.
Yeah.
ask the question the other way, is what would our portfolio be if we hadn't taken the drawdowns we have done in the last 3 years?
I don't think that's.
Well, we do draw, sorry. Can I just follow up, because I think it's, I mean, we do drawdowns because we have, we want to do something.
Well, we're investing in return, yeah.
So that's right. I'll ask the question in a slightly different way then, Nick. Nick, you are charged with RPI plus 3.5%. Whereas you have to invest slightly more cautiously than Charles. So therefore, the blunt question is, do you feel a bit miffed off that we are saying, well, you invest conservatively, but we're still demanding exactly the same term?
One big one.
Yes, absolutely. And I'd say, if we aligned, it wouldn't make sense.
I think that, I mean,
Or would it make a difference?
that would make a difference. I mean, so to give you an idea, that's the outcomes for Henley-Town Council as opposed to an average moderate risk portfolio. And they are much more in line with the sort of figures Charles is giving you for 1, 3, and 5 years.
So they are good.
They are different. But on the other hand, yes, from my point of view, on a daily basis, from my point of view, I have a bigger universe to choose from and more choice about what one does. Charles mentioned the speculative INRG, the iShares Clean Energy.
Yep, indeed.
27% volatility. I couldn't put it in there. I did have some, took a profit, made a nice buck on it, but the volatility on it means that it just doesn't fit in the portfolio. Yes, I don't have a problem with it, it makes my job easier, but at the end of the day, success or failure from my point of view isn't about whether Charles or I get to look like we're one walking wall. It's actually about whether you guys overall get what you want. And our job is to try and deliver that, and if that's with different mandates, you can handle it.
But this actually seems to indicate that A, you're not going to get daft. And if we did change the mandate, then it would be acceptable to the hands. So I had to dig into that. So that gives me the indication that they should be aligned.
In simple terms, the higher level of risk we take, the better we do in the good times, and the worse we do in the bad times. Yeah, that's the view that we take.
Yes.
And the times seem to be reasonable, but not, as you both reported generally, and not terrible, despite the difficulties of the last couple of years.
I mean,
And
can I
that
just give you
suggests
an
to me
idea
that
that might help clarify this issue? If, for example, you guys said, do them both on a moderate basis. Now, I'm going to take a red pen from my point of view. What it would mean, for example, is that when Liz gets in touch and says, cough up, you lot, drawdown time, I would look differently at where I can lose some of that stuff at the moment is much lower volatility, much more cautious, and say some of that can fund the drawdown, as opposed to having to say, do you know what, actually, I've got to keep taking it from the top end of the volatility, the things that perhaps have the best growth prospects, but are higher volatility wise, and take a more balanced view. So it wouldn't actually involve a day one turning it on its head. It would just more fit into things like how one funds the drawdowns and generally the direction of travel rather than a wholesale breach. Because actually, most of that stuff, I think, would be the portfolio. The top and bottom of it would be less weighty at the bottom and a little bit more.
and the change will be gradual, so not a big thing.
Send that after the email me and I suspect, I mean, I'm recognizing.
That's a quickly showed up in the question.
I'm thinking of the any day now.
Let's try and draw the conclusion.
Can I
Sorry.
make one
Sure.
point? I'm just slightly nervous about doing this when you both alluded to the volatility that's coming up in the market over the next 6, 12, 18 months.
In fact, I can't really remember in the 27 years I've been doing this period where there haven't been at least half a dozen big potential clouds on the horizon. This is what we do.
Yeah,
I mean,
okay.
I've yet to ever see a scenario where someone's ever said economically or just looks rosy as far as.
I think a year ago you spoke about it might worse with
And our view then was we got, you know, we believe in this stuff for holding.
Yeah.
Don't tell us to stand.
Giving you moderate risk doesn't mean buy, sell, go crazy. So.
I remember some very gloomy forecasts 10 years ago.
Yeah.
I'm just saying, I was just going to say that Nick and Charles are surprisingly happy for investment managers.
That would tell you something. Okay, let's move to a vote. I think it's fairly subjective. On whether or not we change the red name bentley directive to be moderate from cautious. So I'm going to make that proposal. A second for that? All those in favour? All those against? Okay. So Liz and Nick can make this interpretation. Secondly, on the issue of the 4H in the investment strategy, I'd like to propose that we move to a target ESG score of no more than 25. As an average. A second for that? Okay. All those in favour? Okay, thank you. Are there any other changes that anyone would like to go to review, which is our legal obligation? We do have to review this one. No, I see none, so I think that's the end of this item. And Charles and Nick are free to go. Thank you very much for attending. No, thanks very much for the presentations and your You're very helpful answers, and thank you for the work you do.
Thank you.
Thank you.
Okay, coming back to, we've done item 5, item 6, the draft budget figures for 2022-2023 financial year. The officers want to, or I'm going to let your report speak for yourself for itself.
Thank you.
All right, thank you.
Thank you very much.
Thank you, guys. Page 43.
Yeah, I think it's hopefully suits itself. RPI, you know, the forecast for RPI do keep creeping up, so we've amended it to say, to assume 4.8, we were originally thinking 3.8. But for the items where there is an impact, I'm assuming 4.8%, and this includes the figure for council tax for an average family property. So I'm assuming that we should put that up by 4.8%, and that also assumes that the number of households, the tax rate, that will go up by a certain figure. We now actually have a final figure for that, and it's very, very slightly higher than the figure I'd estimated, which will have an effect of about £1,400 on positive impact on the budget. We'll take that, yeah.
More houses.
Yeah.
Yes, you can.
So, that's what.
Okay. Thank you. Do you have any questions or comments on the budget proposal? As you can see, we're now down to a proposed deficit of 115 for 2022-23. And we don't expect that to change a great deal between now and January the 4th. We have to approve the budget for council. So I'd like to propose that we note and note the current budget account and thank the accountants and town clerk for their work on this sum. Thank you well. All in favour? Okay, thank you.
Can I just ask, will there be a further meeting in the valley, money in the meeting, to try and get that 115 down?
Yeah, 1.7. 1.7.
There is a
We're just
proposal in the
noting,
Recommendation.
that, actually, did you go through the recommendations?
We haven't done 5.1%.
I was going to say, the only recommendation from the investors was that hasn't needed to be addressed. It wasn't for the meeting.
Oh, yes. Yeah, so there is a proposed meeting. I can
That was
where it is on the agenda.
5.5 on
page 98, which is investment.
Yeah.
Yeah, to get the management meet up to do the next investment managers review.
We do need to do that, yes.
Thank you.
So yes, it makes sense to propose that we arrange a value meeting. If there are any proposals for the budget, which can be put in that time, and that can be done as well. Again, we hold the meeting before January the 3rd. Can we hold the value meeting sometime before the end of the year? Early December. Are you happy with that? Yeah. Okay. Budget done. So headway lease to approve the lease renewal for Brotherhood.
Thank you. Broadly speaking, it's a like-for-like renewal. I think there is a very slight increase in annual rent, and so we have combined. They did previously have two leases, one for the hall itself and the garage, and those have been combined into one lease 24. But other than that, it's renewal.
Okay, proposal for those? Proposing, yes. Everybody's checked the recommendation of the report. There's something else to go.
There is no one.
Yeah, second for that, please. Thank you. Any other comments? All those in favour? Okay. Thank you for, at least some time doing that. I've been listening to that. Thank you for doing that so far. Code of conduct complaints consultation. And if anyone who didn't lose the will to live while reading. One of the hard things I found was to understand what the differences were between new proposals and the old. I meant to make you all down. I think I did that, but that was the email I tried to send you with failure.
Yeah.
Afternoon.
I haven't done a very detailed analysis of both. I think the only one that I can see that stood out was that if there is a complaint about a member's behaviour towards the clerk, then the clerk themselves cannot. How do they affect me? That was the only one that I could really note. I don't think there's anything else particularly contentious in there that I can see.
It didn't look as though it was a massive change, as far as I could read.
Well, in the light of things that have happened in Parliament, is there a right to it?
Yeah.
It's in there. Yeah, every stage. Maybe we never have to use it.
The kind of proposal that we.
I was going to read the next part of it. It should be noted that there is no legal power to suspend or disqualify the subject member or withdraw any allowances. I think they should be able to withdraw allowances.
No, that's part of localism act. Change that. So that's national legislation, which we can't change.
I just think that the town clerk should respond to this because they should obviously they're asked, that's what this is asking for. I'm pleased that SODC are updated the code of conduct. I just when I was looking through this, I thought, well, there's areas that aren't really covered, like councillor to councillor, councillor to staff, councillor to member of the public. And it should incorporate, and councillor to clerk, for example, it should incorporate the different scenarios. Because this is being written very much at SODC level, and they probably haven't thought about what happens at a local level so much. I just wondered in your feedback to them whether you would cover those points.
Can you explain which section you're actually referring to?
I'm referring to what this covers. It covers obviously district, town, and parish councils. But I just think it's important to cover off, given that we're a town council, the different levels or the different levels of complaints that can happen. For example, council, member of the public.
In which section of the document are you asking for clarification or to make a comment on?
Wouldn't it be the same pathway? Like it doesn't.
Well, no, because so the one to the clerk should be the mayor, shouldn't be to the SODC. So if there is a complaint.
Yeah, please.
Yeah, so we do have a complaint policy that that outlines what happens if there is a complaint about, say, for example, a complaint about a staff member, for example. This only covers complaints made about councillors. I suppose we can go into those individual scenarios as such, but it covers all complaints made about councillors, and that's the thing. I don't think anybody covered by the code.
That is, sorry, and that is the important thing. It's not to subdivide it into council versus council, but member of the public versus council. It's focusing on breaching of the code of conduct. That's the important thing. And it's irrelevant to it is. It's the code of conduct that's the important thing.
Yeah, but only councillors
Yeah.
are signed and agreed to abide by the code of conduct. But officers have to abide by certain codes of conduct. Those are regarded. Those are more about employment law, not the localism act, which is what never here. Sorry.
Is to the town, is it one of the seminars that Patrick Aaron from the
district council's trying to take?
I believe, yeah, he is running a few, well, kind of standards of behaviour, which is brought forward the code of conduct training. Yes, which I've sent round to councillors. Well, most councillors will have been, had the code of conduct training earlier this year. However, for any councillors who haven't, I still recommend they have those, that link. I'm sure he'll be a very good trainer.
Because he has changed, or he's trying to change a fair few pieces in the code of conduct.
Do you mean he's trying to change it in this?
Yeah,
Or-
and he's trying to identify areas which he thinks change.
I think there are two separate things here. The first is how the complaints are dealt with. The second thing is the code of conduct itself, because the LGA brought out a new kind of model code of conduct a few months ago, and the district the various monitoring officers from around Oxfordshire are still discussing it with a view to having one recommended code of conduct for all the parties in. So they're still working on that.
I was going to say, John, the council have a two things. If you go to the seminar, you can ask him any questions. And, he'll give you the answers. There are 2 or 3 councils down in Wales, and we normally refer to the problems that we ever had come from Wales. But as well,
They speak a different language from it.
Okay, so.
This is quite straightforward.
Yeah, well, we have a proposal to approve the, to approve the agreement. All in favour of that proposal? We've done item number 9, and item 10 down to include the public impression, which is
Backing up.
so
an hour ago.
I'd like to propose that the public and press includes the remainder of the meeting in accordance with public review of official meeting that item 50 publicity and prejudice of the public interest by reason of the confidential nature of the business. All those in favour?
All that happens. Whilst Norris is back, would you be able to just witness this, just sign your name and yes, sign and then your name.